Hello and welcome to another chapter on US taxation. So, in the previous chapter, we learned how the US tax administered system is administered. We understood the role of the IRS. We understood the how federal, state, and the local tax authorities operate, how taxes are collected and enforced, how taxpayers file the returns and stay compliant. So now we understand who runs the system and how it works. But this brings us to the next big question. What taxes actually exist in the United States? What taxes are taxpayers paying throughout their lives? This is exactly what we will explore in this chapter. So in this chapter, we move from the tax administration to type of taxes. We will focus on the major federal taxes that forms the foundation of US taxation and are most relevant for the tax professional. We will break down and understand federal income tax, which is tax on earning money, payroll tax, which is tax on working, capital gain tax, which is tax on investment, estate and gift tax, which is tax on wealth transfer, federal excise tax, which is tax on specific goods and industries. And by the end of this chapter, you will have a clear picture of the core taxes that drive the US tax system. So with this, let's move to the next slide and look at the detailed agenda that we're going to follow for this chapter. Okay, so the agenda that we are going to cover today as a part of this chapter is we'll quickly have a look at understanding on the US tax landscape, wherein we'll understand why different taxes and taxes related to life stages and the economic activity. We'll look at the key federal taxes and we'll explore the concept of federal income tax and federal corporate income tax, which is on earning money. We'll also look at the payroll taxes, which is working and which is on the working and the employment. We'll have a look at the federal capital gain tax, federal excise tax, estate and the gift tax, which is wealth transfer, and then we'll have a look at the key takeaways. So from this chapter onwards, our focus is largely on the federal taxes, and as we move further, our larger concentration would be on the uh, direct taxes, which is like income tax, tax on the capital gain, federal tax on the payroll tax, and the federal tax on the income as well as the corporate income tax. So our focus would be largely on the direct tax portion of it. We'll also touch base on estate and the gift tax, but we will exclude the detailed explanation of the federal excise tax. So we'll move to the next slide. Okay. So now we'll talk about the understanding the taxes, which is like taxes which is imposed by the IRS, which is the federal government. So how the US tax system is structured. So US tax system is designed to tax different economic activities throughout the life of the person and the financial journey. So instead of classifying taxes as direct versus indirect, the US focuses on taxing the income when you earn the money. So when you earn the money, the income tax is the tax which is being charged by the federal authority. An individual or business generate income, the government collects the income tax. So when you earn money. So example of income activities like salary from the job, business profits, and the investment income. All these activities will generate the income, and income is subject to the tax, which is whether it is individual or a corporate tax. Taxing the employment when you work. So when people work and earn wages, the government collects the payroll taxes to fund the social welfare program. So fund support like retirement benefits, social security, and healthcare for the elderly, Medicare. So taxing the consumption. So when you consume the goods or when you spend the money for the consumption, then comes the concept of the sales tax, which is being applied by the states and the cities. And we are not going to talk in detail about the sales tax because we are only going to concentrate on the taxes which is imposed by the IRS, which is being administered by the federal government. And taxing the wealth transfer when wealth moves between the generations, when large wealth is transferred through the inheritance or gift, then we have the estate and the gift tax applies. And then we also have the excise tax, which is being charged by the federal government on a certain set of the consumption and the certain set of the manufacturing, which we are going to talk about in detail in the upcoming slides. So when we compare this entire slide with the life stages, so when we start the job, we earn salary, then we pay the income tax and payroll tax. When we buy the goods and services, we pay the sales tax. When we build wealth and assets, we pay the capital gain tax, and when we transfer the wealth, we pay the estate tax. And when we manufacture certain set of goods, we also pay the excise tax. So for excise, we are going to have a separate discussion. We have a separate slide for that. But for the larger discussion and future chapters, we are largely going to concentrate on the direct taxes part of it, which includes the individual income tax, corporate income tax. We also talk about the capital gain tax as well as the tax on the transfer of the wealth, which is estate tax and the gift tax. So we'll move to the next slide. Okay, so in the last slide, we closely covered like the basic concept of the taxation, which is being charged by the U.S. authorities, which is like income tax, and then we also talk about the sales tax, and then we also talk about the capital gain tax and estate and the gift tax. This slide, we're going to cover the key federal taxes, and we're going to study all these key federal taxes in detail, apart from the federal excise taxes, because that largely is treated as the indirect tax, and we are going to cover largely the direct taxes portion of it as a part of the upcoming chapters and the upcoming discussions. So when we talk about the federal taxes, we'll quickly have a look at how it is being spread. So federal taxes applies across all the 50 states and form the core focus of the this learning series. As US tax professional, most of your work will revolve around these federal taxes and the related IRS forms. So we'll talk about each of them in detail in the upcoming slides. So when we talk about the federal income tax, the primary focus of the series, the tax of the earning on the individual and the businesses. So which all incomes are covered here? So salary and the wages, freelance income, investment income, rental income, capital gains, deductions and credits are there. And then we have form 1040 preparation, which is the filing form for the return. And this is the largest and the most important area of the US taxation. Then we are also going to cover the payroll taxes, which we normally call as FICA, employment taxes. Taxes US funding the US Social Service Program, which includes the Social Security tax, medical care, self-employment tax, employer versus employee contribution, important for the payroll and the freelance and for the business returns. We'll also talk about the federal capital gain tax, which is the tax on the sale of profit arises on the sale of the asset, which can be a stock or a mutual fund, real estate asset, short-term, long-term gain, and then with Schedule D, which is like form number 8949. We'll also talk about federal corporate income tax, which is tax on the profit of the corporation. Tax rate for the corporate is 21%, which is again it has a form of 11120, and then the business reduction, the double taxation concept. We'll also talk about the estate and gift tax, which is high net worth taxation, taxes on the transfer of the large wealth, estate tax threshold and the exemption, gift tax rules, and the wealth transfer pricing. And then we have federal excise tax. We'll touch base upon this tax in just for the understanding purpose, which is awareness level, but we are not going to talk about in detail. Our primary focus is to cover the income tax, payroll taxes, capital gain tax, corporate income tax, and the estate and the gift tax. So federal excise tax is a tax on the specific goods and services, example fuel, alcohol, tobacco, and the air. So when we look at the kind of the taxes which is imposed by the federal, so largely federal imposes these six taxes, which is federal income tax, payroll taxes, federal capital gain tax, federal corporate income tax, estate and gift tax, and then federal excise tax. And as part of our curriculum, we are going to focus on the first five set of the taxes in detail, and we are going to just have a quick look for the federal excise taxes for the awareness purpose. So we'll move to the next slide. Okay. So in this slide, we're going to touch base on the federal income tax and the federal corporate income tax. And this is just kind of briefing a bit more understanding on what these taxes are. The detailed explanation on all these taxes will follow as we move forward in our series. So when we talk about the federal income tax, what is it? It is the tax imposed on the income earned by the individual during the year, filed annually using the form number 1040. And sources of individual income is salary and wages, which is largely through W2 form, which is submitted by the employer. Freelancer consulting income submitted through 1099. Interest and the dividend income, capital gain from the stocks and the properties, rental income, and the business income. So these are the kind of the income on which which is subjected to the income tax under the federal system of taxation, and the US residents are taxed on their worldwide income. This is very, very important. So how it works? So calculate the gross income, subtract the deduction, arrive at the taxable income, apply the taxes, and reduce the tax using the credits, which is like the tax which is being withheld that is reduced to get the final tax that needs to be paid upon. So example, salary income is 90,000 USD. Standard deduction is 14,600, which is a fixed standard deduction. Taxable income is 75,400. Tax calculated in the range of because it's a progressive rate system. Bracket based upon the tax rates based upon the bracket of the income in which an individual falls. So higher income is equal to higher tax bracket. So this is a normal tax procedure that is being followed. So this is a normal concept that how income tax is being charged on the individual. We'll move to the next slide. Okay, so in the previous slide, we saw that how income tax is largely calculated for an individual SSC. Now, in this slide, we are going to quickly touch base upon the profits which is earned by the corporates and the tax which is being charged on the corporate bodies. So, federal corporate income tax is like tax on the businesses. What is it? Tax on the profit earned by the C corporations filed using the form 1120. Corporate tax rate, flat federal corporate tax rate is 21%, applies to the company profit after expenses. What counts as corporate income? So revenue from the product and services, investment income, licensing or royalty income, international business income. So corporate income is revenue minus business expenditure, taxable profit. A rate is applied on the taxable profit, which is like federal corporate tax. Quick example here: company revenue is there. We have 22 million dollar as a revenue. Then expenses is 1.4 million. Taxable profit is 0.6 million. Federal corporate tax is 1,26,000 USD. So this is how a normal computation of taxable profits and then calculation of taxes happen. So this is just a just a kind of a snippet to demonstrate that how simple tax calculation happens. But when we move forward, we'll have the detailed practical example and multiple scenarios to understand various complex business scenarios and the calculations as well. So we'll move to the next slide. So we have a kind of a double tax in US wherein the profits are being taxed at the corporate level, and then the dividend which is being declared by the corporates that is again taxed in the hand of an individual. So double taxation concept: corporate profits may be taxed twice. Corporate pays the tax on corporate tax, and shareholder pay the tax on the dividend. This is called double taxation. So individual form is 1040, corporate form is 1120. Individual rates are progressive tax rates. Corporation rates are 21% flat rate. Individual is normally treated as a tax on the personal income and the corporation tax on the business profit. So this is a quick synopsis of how tax is being charged on the income for the individual as well as the corporates here. So we move to the next slide. Okay, now we'll come to the second set of taxes, which is the payroll taxes, and which largely includes the two set of taxes here, which is Social Security and the Medicare. So tax on the employment income in the US, the payroll taxes are imposed on the wages and salaries to fund the major US social welfare program. These are collected automatically through salary withholding. So it means that an individual who is being employed, that is being deducted by their employer and being deposited by the employer to the accounts of the federal government. So payroll taxes finance the social security and the Medicare, healthcare for the people aged 65 plus. Every working employee contribute to this program. FICA, as we talked about in the earlier slide, means the Federal Insurance Contribution Act, which governs the Social Security and the Medicare. So component is Social Security, employee rate is 6.2, employer rate is same as that of the employee. Similarly for Medicare, the employer rate is 1.45% and same is for the employer as well. The total contribution to the government is 15.3% when we add all these four contributions. So employee pay half, employer pay half, Social Security is wage limit. Social Security tax applies only to annual salary cap, approximately 1,60,000 plus range, updated. Medicare has no salary cap. So which means that Medicare has no salary cap, but Social Security applies only up to an annual salary cap, which is approximately 1,60,000 in an yearly basis. So freelance and business owners pay both the portion because freelance do not have a kind of an employer-employee engagement. They have their own setup and hence they have to pay the entire 15.3% as a self-employment tax rate and contribute to the accounts of the federal government as a form of the Social Security plus Medicare contribution. And then payroll taxes impact the salary, income taxation, freelance and the gig worker, uh, business payroll compliance, and the retirement of the social security benefits. So typically, what is the synopsis of this slide is that social security tax and the Medicare tax is being imposed on the employee, deducted from the employee's salary and contributed to the account of the federal government. It's being contributed equally by the employer as well. And in the case of for the self-employed persons, this is being the entire contribution being contributed by that self-employed person into the account of the federal government. So we'll move to the next slide. Okay, so we have created a table as well to demonstrate that how the Medicare as well as Social Security taxes are being imposed and what is the limit to it. So this table clearly shows that if there is a salary up to 1,60,000, then Social Security tax is 6.2%, which needs to be deducted by the salary of the employee, and then employer has to contribute the same as well. Medicare is 1.45%. There is no extra Medicare. The total payroll tax is 7.65% from the employee salary. But in the after 1,60,000 to 2 lakh, social security is not required, which is 0%. Cap has reached 1.45% of Medicare is still there, but there is no extra Medicare. Total contribution is 1.45%. Above 2 lakh, social security is 0, Medicare is 1.4, and then 5%, and then extra Medicare is also required, which is 0.9%, and this makes total contribution of 2.35%. So first slide, if you look at it, normal income earners, for most employees earning below the social security wage cap, total payroll deducted is 7.6%, which is like social security of 6.2%, Medicare of 1.45%. For second slab, which is high earners, once salary crosses social security cap, social security stop, only Medicare continues and tax reduces to 1.45%. Third slide, which is very high earners above 2 lakh salary, social security is 0%, Medicare is 1.45%, and then additional Medicare of 0.9% is being charged, which makes a total of 2.35%. So this is how the payroll taxes is being collected and then deposited into the account of the federal government. So we'll move to the next slide. Okay, so now we're going to talk about another tax, which is federal capital gain tax, which is being tax imposed on the profit arising from the sale of the assets. So tax on the profit from selling of the assets. So federal capital gain tax applies when the taxpayer sells an asset for more than its purchase price. So tax is charged only on the profit or gains, not on the total sale value. So assets subject to capital gains are the stocks in the mutual fund, real estate property, bonds, cryptocurrency, and the business investments. So apply to both the individuals as well as the businesses, which includes the corporates. So again, here we have two holding periods, holding period less than 1 year and more than 1 year. So tax type would be short-term capital gain if it is less than 1 year, and tax rate may tax as the normal income tax rate. It is a slab based if it is an individual, and it is a normal income tax rate of 21% if it is a corporate income tax. More than 1 year, then long-term capital gain, which is LTCG, taxes at the lower special rate. So short-term capital gain, if it is sold within the 12 month, added to the regular income tax using normal income tax bracket, which is 10 to 30%. If it is long-term capital gain, if it has held in more than 1 year, special lower rate would follow. So, so here we have created that limit. So falls within the 0% LTCG bracket as per IRS threshold. So LTCG rate is 0%. Falls within the 15% of the LTCG bracket as per the IRS annual threshold, then it has to be 15%. Falls within 20% LTCG bracket as per the IRS threshold, then it is a 20% rate. So depend upon in which bracket it falls, then the appropriate rate would be charged on the basis of the income for that particular individual. So these brackets are published by the IRS every year adjusted for the inflation. The rates remain constant at 0%, 15%, 20%, while the income threshold change annually. So this is how the tax is being charged on the LTCG. So we'll move to the next slide. Okay, now the tax that we're going to talk about is federal excise tax. And we already mentioned that we are going to discuss this for the awareness purpose. We're not going to do a deep dive on these excise tax. So tax on the specific products and the activity. Federal excise tax are imposed on the specific goods, services, and the activities rather than on income. So they are included in the price paid by the consumers and collected by the businesses on behalf of the government. So purpose of federal tax is to excise taxes are used to generate the government revenue, discourage the harmful consumption, fund specific public program, support the infrastructure and the healthcare, often called as the sin taxes or the usage taxes. So federal taxes are the taxes applied to wide range of the specific goods and services and activities defined in the Internal Revenue Code. And the most important thing is that there is an inclusive list for the goods and services on which excise is being taxed. So which is like it has bifurcated all these items here on which excise is being charged by the federal authorities. First is fuel and energy taxes. Second is alcohol, tobacco, and the firearms. Taxes on the transportation of the transportation excise taxes, and then environmental excise taxes, health related and service excise taxes, and then the insurance and the financial excise taxes. So which means that typically it has classified the list of the services on which excise is being charged by the federal government. So which is like fuel and energy, alcohol and tobacco, transportation, environment, and then health related services, and then the insurance and the financial excise taxes. Applies to specific cross border situation, includes foreign insurance premium, certain reinsurance transactions. So, which means that there is a specific list on which excise tax is being charged, and each of the category has its own set of the rules and the rates on basis which the tax is being charged at the time of the production of the goods or services, and that is the trigger point for taxing the authority, or that is the point at which tax accrues to be paid to the federal government. Okay, so we'll move to the next slide. Okay, so what then we have created? We have created a small table here to demonstrate the tax which is being charged on the various category on the of these goods and services. So, for example, fuel and energy taxes typically taxes per gallon per unit, and the approximate range is zero point 0.8 per dollar to 20.25 per gallon for fuel. For alcohol and beer is per volume gallon, which is $3 to $27 per gallon, varies by alcohol type. Tobacco products is per pack per weight. Air transportation is percentage of ticket plus fixed fee. Heavy vehicle and the highway usage is annual fees and the sale price. Environmental and the chemical taxes is per ton per chemical. Indoor tanning services, foreign insurance premium, and the firearms and the ammunition. So which means that each kind of the services on which tax is being charged, the typical tax base is different depending upon the kind of services which they are paying, and then the approximate rate range is also different depending upon the services that they are paying. For some it is like per unit or per ton, and for some it is a percentage basis. So this means that federal excise tax is a kind of inclusive tax which tax on a certain set of the services and the goods that is being produced, and this is to make sure that the revenue is collected and used to fund multiple activities which is being administered by the federal government. So we'll move to the next slide. Okay, so now this is the last one of the federal taxes that is being charged, which is the estate and the gift tax. So while estate tax is charged when the individual passed away leaving his estate, and the tax is being charged on the estate of the individual. A gift tax is largely being charged on any gifting which has been done by individual to another individual, and then there's a tax that is being charged which is being to be paid by the payer of the gift. It is not being charged on the recipient of the gift. So tax on the transfer of the wealth in the US. So estate and the gift tax applies when the wealth is transferred without receiving equal return in the equal value in the return. This may includes the high net worth individuals. So purpose of the estate and gift tax, the government uses this tax to prevent the excessive wealth concentration, ensures the large inheritance are taxes, generate revenue for the ultra high net worth estates, so often called as wealth transfer tax. So estate tax is largely after death, tax applied on the total value of the assets owned at the death. Asset includes the real estate, investments, business ownerships, cash in bank account, retirement account. And then state tax, there's a threshold. So state tax applies only above very high exemption limit. So a limit is $13 million per person, inflation adjusted yearly. Most Americans never pay a state tax. A state tax example is equal to a state tax. If let's say there's a state value of 15 million, exemption is 13 million, then taxable estate is 2 million, and then the rate would be applied on this 2 million and tax needs to be paid. So gift tax is basically gifting any amount to any person without the required consideration, then it's during the lifetime, applies when the person gives money or assets to during their lifetime without full payment in the return. So example, giving cash to the children, transferring the property to family, large financial gifts. Small gifts are tax-free up to the annual limit of approximately $17,000 per recipient. So which means that if an individual has given gift to the 5 recipient, then it will not be charged because all that's the total is per recipient. It's not at the accumulated level. And in this case, also the tax is being charged to the person who is paying, giving the gift, and not the person who is receiving the gift. So estate and the gift tax work together. Very important concept. Estate tax plus gift tax share the combined lifetime exemption limit. So this prevents the people from avoiding a state tax by gifting the wealth before the death. For example, a combined system. So which means that if certain individual has already gifted a particular amount, then the amount that they have been gifted would be added to the exemption limit that will be finally taken into consideration while paying the final output liability. That has to be combined, and then the lifetime gift reduces the estate exemption. If a person gives the large gift during the life, then the remaining estate exemption become lower. So which means that if the exemption has been 13 million, and out of 13 million they have already given a lot of gifts, that amount will be reduced from the 13 million exemption, and then that lower exemption would be applied at the time of calculating the estate tax. So move to the next slide. Okay, so we quickly talk about the person who is liable to pay the estate or the gift tax. So when we talk about the person giving the gift, person giving the gift will pay the tax. The person receiving the bill, receiving the gift will not pay any tax. But in the case of deceased person, the deceased person estate will pay the tax. The beneficiary are not going to pay any taxes here. So which means that recipients are not liable to pay any tax, whether it is a gift tax or whether it is a state tax. The in the gift tax, the payer of the gift is going to pay the tax, and in the case of the estate, the estate of the deceased is going to pay that tax. So with this, we'll come to the end of this session. We'll quickly have a wrap-up slide on the key takeaways, and then we'll summarize that what we have learned in this particular chapter. Okay, so as we talk about the key takeaways, key takeaways from this chapter is that we understood the core federal taxes that forms the foundation of the U.S. tax practice. We understood the federal income tax, payroll tax, capital gain tax, estate and gift tax, and the federal excise tax. So with this, we have completed the three chapter of this particular module. So module one completed, introduction to U.S. taxation. We have now completed module one, covering the foundation of the U.S. taxes. Chapter one, how taxation works. Chapter two, a role of the IRS and the administration. Module and the chapter three, which is type of the taxes in the U.S. So we have completed the all the three chapters for this particular module. Next, we are going to come up with the module two. Module two is the taxpayer concept. Now we'll move to the tax system to the taxpayer rule. So we are going to come up with the chapter 4, which is the first chapter of the module 1 module 2, and we are going to talk about the type of the filing of the returns. We are going to talk about the who's going to file the return, US tax citizen versus non-resident alien. We'll talk about the substantial presence test explained, and then filing status bracket basis single, married, and HOH. So we'll talk about all this in the upcoming chapter. So we'll move to the final thank you slide. Okay, so I think by now we must have understood the concept of the U.S. taxation, how the U.S. taxes are constituted, and then what is the framework within taxes are administered. We talk about the federal government, we talk about the state government, we talk about the local authorities, and we also understood that there is this one state central government, which is federal government, 50 state government, and then 70,000 plus tax jurisdiction at the local level. We also understood the multiple taxes which is being imposed by all these jurisdiction, and we also shortlisted the taxes that we're going to study as the part of this curriculum, which is like all the federal taxes. We're going to touch base with for the individual income tax, corporate income tax, capital gain tax, estate tax, and the payroll taxes, and we'll simply brush the concept of the federal excise tax. So we have completed the module 1. We're going to start the module 2 very soon. We're going to cover the next chapter where we'll talk about the concept of filing the return, the limits at which return is to be filed, and the various forms. And we'll also talk about the residential status, substantial presence test, and how the tax is being calculated. So with this, we'll come to the end of this chapter. Thank you for watching this video. Do let us know for any comments or any suggestions in the comment section. And please subscribe the channel and like this video. Thank you.